Welcome back to Market Watch. Well, disappointing July jobs numbers shocked the street on Friday. U.S. employers added 32,000 workers last month. This is much lower than the 228,000 that were forecasted. Now, the number fueled fears that the world's largest economy is stuck in a quagmire. And combined with higher oil prices, it casts doubt on the U.S. economic recovery. The next test for the economy comes when the Federal Open Market Committee meets on Tuesday. Most economists still expect that the Fed will raise rates by 25 basis points, but the future is looking pretty murky. For more, we're speaking to Peter Churchouse. He is Director of LIM Advisors, and he's joining us live from our Hong Kong studios. Peter, thanks so much for joining us. So what do you think? I mean, what about the rest of the year? A lot of people are already assuming that the Fed is going to raise rates at the next meeting in a couple of days, but what about the next couple of Fed meetings? How confusing is all this data going to make it for the Fed?
Well, quite honestly, yes, the numbers last Friday were indeed very shocking, and I think economists have not got a number quite so wrong for quite a long period of time. But having said that, though, I suspect that the Fed will continue with its policy of tightening gradually over the course of the rest of the year. The Fed funds rate at 1.25% versus inflation of 3.3%. Monetary policy is still very, very accommodative indeed, and I'm expecting we'll see that the Fed will continue to gradually move towards neutrality in monetary policy. It's been stimulative for far too long in many people's views, so I think we will see this continuing tightening, 25 basis points at a time. I'd be surprised if we did not see that happen tomorrow, in spite of last week's numbers.
Peter, the U.S. markets right now, we've got the pullback that we've had on Friday, but the key question here is Greenspan doing the right thing at this point by increasing rates? I mean, for the most part, the street expects it, and I think we all understand that. But this is the right move, right?
I think it is absolutely the right move. We could argue that Greenspan's former moves have been too accommodative to the markets. In fact, many people would argue that all the Fed has done over the last year or two is promulgate a huge asset bubble in property in the U.S. It's promulgated what is in effect the global carry trade of U.S. dollars that has been very much in force in financial markets around the world. So the big argument really is that these asset booms that have been created by Fed policy need to be washed out of the system and get back to a more normal and neutral monetary policy in the longer term. Otherwise, this will fuel inflation and asset bubbles, which can be much more painful further down the track.
And we'll be back in just 2 minutes with Peter Churchouse, Director of LIM Advisors, for a look at the toll of higher oil prices on the global economy. Peter, stay right there, and we'll be right back. Welcome back to Market Watch. We're going to go now back to Peter Churchouse. He's Director of LIM Advisors, and he's joining us live from our Hong Kong studios. And we're, of course, going to be talking about high oil prices. Now, Peter, a lot of people are now talking about oil prices at $50, $60 a barrel. A lot of people concerned that this could actually get the U.S. economy back into a recession. What are your thoughts on that?
Well, quite frankly, I think in the short term, oil prices are very likely to stay very high. It's not just about fears of terrorist threat and disruption to supply. We do have a world where genuine end-user demand is extremely strong. Oil growth and demand this year is expected to be about 3.2% this year versus an average over the last 10 years of around 2%. So that's a huge uptick in demand here. And at this point in time, there was also a very tight supply scenario. Saudi Arabia thinks they can bring on another 1 million barrels a day. There's another 500,000 perhaps in OPEC. But generally speaking, supply is tight and demand is as strong as we've seen it in 10 years. So yes, certainly expect oil prices to stay reasonably high in the short term at least.
Peter, maybe the key word here is reasonably high, because I think there's talk out there of $50 plus $60, $70 a barrel. You name the number, it's probably out there. But the reality is, though, is as oil does continue to move higher, at $50 a barrel, we're talking about $3 a gallon on the U.S. side, depending on which state you live in and which refinery your oil comes from. But at that price range, demand will certainly has to drop off at some point, not just on the U.S. side, but also worldwide. What price is that we would see demand significantly drop off?
Well, quite frankly, the oil price spikes like we're seeing right now typically are, in a way, a self-adjusting mechanism. And over a 3 to 12 month period, when we've seen these spikes in the past, we do get to see a slowdown in global demand, a slowdown in economies. We also start to see consumers behaving differently. We see, back from previous spikes, we've seen the use of smaller engined cars. We look at alternative fuel supplies, fuel sources, more use of gas, etc. So I think you do tend to get a self-adjusting mechanism when prices spike this much. Bear in mind that prices are still about really just over half of the real prices that they were in the last spike. So yes, it certainly means more to fill your tank, but really we're nowhere near the levels that we've seen in previous spikes in real terms and its impact on the end consumer and on the domestic or the real economy.
All right, Peter Churchouse, thank you so much for joining us. Peter Churchouse is Director of LIM Advisors, and he's joining us live from our Hong Kong studios. Thanks again.